Hello trade pros. In this video, I'm going to explain everything you need to know about trading leverage, how to avoid some of the common pitfalls, and how to use it to your advantage. Let's get started. When new traders start out and first learn about the concept of leverage or trading a bigger account size than you have in cash, they immediately get excited and think about the potential and possibilities of becoming rich very quickly. However, the truth is, at the beginning, leverage is actually one of the most dangerous tools in the hands of someone who's new in an industry and still learning their way around. So what is leverage? Leverage in general means being able to control something bigger with a smaller amount. In trading, leverage gives you the ability to buy more stocks in your account than you have the cash to pay for. The best way to explain leverage is to use an example. Let's assume you want to buy 100 shares of a stock that costs $100 per share. How much money would you need? $10,000 US in your account to purchase just one stock. When most traders start out, they want to start out smaller than that. In fact, if you want to learn how to start investing with a small account balance, you could click right here and get more information, or click the link in the description of this video. Assuming you want to purchase $10,000 of stock, but you only have $3,000 in your account, what could you do? The answer here is leverage. The broker that you have an account open with and have your money deposited in will actually lend you money to purchase a stock. The loan that they provide you to purchase a stock is called loan value. The amount of money that you have to put down, that's a difference between the cost price minus the loan they're providing, is called the margin. Before we dig into leverage though, you need to understand under what circumstances will the broker lend you money. Brokers will give you money to purchase a high quality stock, one that's a blue chip that has value and stability in it. If you're looking at smaller penny stocks or companies that aren't worth much on a per share basis, most brokers will provide you no loan value or no margin whatsoever. For the big companies like Apple, Google, Amazon, and any major blue chip stock companies that are publicly traded, most brokers will give you a loan of anywhere between 50% to 70% of the purchase price. Assuming that stock A is actually Apple and it's trading for $100 a share, this means that your broker will give you 70% of the purchase price as a loan. Because it costs $10,000 to purchase it, the amount of money that you'll need to put down is actually $3,000. This portion is called your margin. Margin is the amount that you contribute to the purchase and not the amount that the broker is loaning you. But why would your broker lend you money to begin with? Because they're your friend. Just kidding. They provide you that money as a loan. The amount of money that you borrow from a broker, you actually have to pay an interest rate on. Most brokers will charge you the prime rate plus an additional percentage on top. A common one for new clients is prime plus 1.25%. This means that for the amount of time you're borrowing the money to purchase a stock, you have to pay that annualized interest rate on a daily basis. It's not 5% a day, it's 5% a year broken down on a daily basis. So oftentimes the cost of holding a margin position is actually pretty low. Now that you understand margin, it's time to go back to the concept of leverage. Just to review, margin is the amount of money that you put down, the broker lends you the additional, and now you could purchase more stocks than what you have cash in your account. The problem occurs when new traders use margin or heavy leverage to take positions that are out of their comfort zone or their knowledge and expertise level. To calculate your leverage, you simply divide 1 by your margin rate in percentage. In our example, because we're putting down 30% of the purchase price, we divide 1 divided by 0.3. This gives us a leverage ratio of 3.33 to 1. So this is great. You've purchased a stock at $100 per share. You've borrowed money from your broker. There's only two things that can happen in a potential third. The first one is that the stock goes up in value. The second one is that the stock decreases in value. And the third one is that the stock does nothing. However, if the stock doesn't go anywhere, there's no real risk. The only cost to you is to service the loan provided by your broker, and that's the margin interest rate that you have to pay. The other two scenarios are more interesting. If your stock increases in value by just $10 or a 10% return, and you own 100 shares, you have now made a grand total of $1,000 on that position. If you divide the $1,000 profit by the $3,000, which is the capital you started with, you've made a whopping 33% return on your capital with just a $10 move. So what do? You go online and you start looking at different color options and interior configurations of a Lamborghini. And this is the part that excites traders the most and that leads to devastating results. True traders are compensated for the fact that they manage risk well. So as a new trader, it's important to put your focus on identifying your potential loss and all your attention on managing your risk. The returns come as a reward of being a good risk manager. That's the simple truth in this business. Now let's look at scenario number 2. Let's assume that the stock actually goes down by $10, the same amount it increased. If it drops by $10, because you own 100 shares, you lose $1,000. This $1,000 loss corresponds to a 33% loss in your account of your own money. If the stock continues to drop, there comes a point where you lose all of your money and the broker automatically sells your position, and that's called a margin call. You either could deposit more money to hold the stock, or they could sell it for you and get rid of it on the market. A margin call means the broker wants their money back and you've lost a substantial amount of money. So if the stock actually only goes down 10% and you're taking a 33% draw on your account, you can imagine that if you do this 3 to 4 times, you'll be left with very little capital. So forget that Lamborghini, you're riding a bicycle. So here's the problem with using leverage at the very beginning. When you're new, the focus is oftentimes on making as much money as possible. However, by increasing your leverage and borrowing money to buy a position size that you're not comfortable controlling, you're exposing yourself to a very big risk. You have to be right. You put yourself in the do or die scenario, and that scenario actually triggers cortisol, and it triggers the reptilian brain in your mind that releases fear. And when you start trading or investing from a place of fear and emotionality, this leads to a lot of losses and uncomfortable moments. Also, because you're in a big position, you need that position to go right in your direction right away. You can't take a lot of a drawdown because you're leveraged and your losses are exponential in comparison to your account balance. This puts the pressure on you that you have to be right. You have to pick the stock at the right moment and you have to time it precisely in order to protect your capital. However, one thing that you'll learn by trading in the market or investing is that there's never a right moment. What a real trader knows is this: there isn't a perfect entry. There is just a level for which the opportunity is worth the risk you're going to take. And there's always a risk because you never know where an asset's going to go. The entire purpose of the market is to price an asset. So assuming that you're going to know the end destination is not a realistic goal. So this is why leverage is dangerous. It puts pressure on you as a new trader to make money and to be right away. However, if you're just getting in this industry, the real key focus here is to learn. You need to reduce your pressure and put yourself in an environment where you could start to assimilate and learn the traits, behaviors, and habits of highly successful traders. The next step that you could take is to actually start to learn how to trade. What does that journey look like? Well, you could start by taking a course or doing some research online and all of our YouTube videos as well. As you begin to learn the industry, you're going to be able to start trading in a demo or simulated account. Here you could experience the actual conditions of trading in a non-risk environment. At that point, you'll be able to make some observations and create a trading strategy for yourself that includes risk management. You'll then begin to journal your trades, and when you're ready to actually use live capital, you'll know enough in order to give yourself a realistic and high probability to succeed over the long term. So where do you get all this education? There's good news. We have a free training course that you can watch that'll provide the link to you in a moment. And in addition to that, we give all of our traders a live environment. The most important thing to realize about trading is that it's not an individual game. It's actually a team sport. Our TRADEPRO Academy team trades daily and interacts with one another in our community, and it's highly engaged. So by this point, you've learned a lot about margin, leverage, and how to start trading. There is one thing that you want to maximize your leverage on, and that's your learning and your screen time. So to get started, head on over and come trade with us. And I'd love to hear from you. What more do you want to learn about? And if you have any questions about leverage or margin, please put them below and we'll answer them for you. If you've liked this video, please click here to subscribe now and be sure to hit the notifications bell to receive updates when we have new videos. If you want a copy of our 6-lesson free trading course, click here and get started now. I hope you've enjoyed this video and I'll see you at the next one. Remember, manage your risk and trade like a trade pro. Thank you and goodbye.